Good morning, everyone, and thank you for joining. My name is Andrew Tobin, and I'm a partner specialising in insurance and reinsurance at Mills & Reeve. Today's session is one way. You can see us, but we can't see you. It is being recorded, and copies of a link to this session with slides will be sent out in the follow-up email. Today's presentation will be 15 to 20 minutes long. If you have questions, please type them into the question and answer box, where my colleague Harriet Strevens will collate them for me to deal with at the end. So in today's session, I hope to give you a brief snapshot of what loss can mean in different insurance situations, because the answer is not always as clear as people might think. And in everyday speech, loss can mean different things in different contexts. As Sir Martin Norse, a Court of Appeal judge, observed, loss, as I've shown on the slide, loss is a word whose meaning varies widely with the context in which it is used. If a man said to you, "I have lost my wife," you would understand him to mean one thing outside the maze at Hampton Court and another outside an undertaker's in the street. That said, as far as the law is concerned, as opposed to everyday speech, we can refer to case law to see what the courts think that loss means. Next slide, please. So at a high level, the purpose of insurance is to protect the insured against something that adversely affects its financial position. Some policies protect the insured for loss arising out of loss or damage to physical objects, such as property or cargo. Other policies protect insureds from financial loss that need not derive from damage to physical things. Examples would be liability insurance or credit insurance. And then there is also business interruption insurance, but that is usually also contingent upon damage to property occurring first of all. We're going to leave those types of policies to one side today and focus just on loss or damage in the context of physical things, i.e. to property. We'll be looking at physical loss or damage, and we're looking at deprivation loss, where there's strands in the law of marine insurance and also in the law of non-marine insurance. And finally, we'll wrap up looking at the so-called wait and see cases. So property insurances are nearly always expressed to provide cover for loss of or damage to the insured property. You might not think too much about the physical loss requirement, but it can be important. It highlights that the loss does not provide indemnity for types of pecuniary loss that do not derive from physical damage to property. But what is damage to property? Have the next slide, please. Well, the cases show that damage in a property policy refers to some, quote, adverse physical alteration and not mere loss in value, end quote, or paper losses caused by something else. And this was recently illustrated in the TKC case shown on the slide. That case concerned a creperie in Kensington that was required to close as a result of the coronavirus pandemic lockdown rules. The policy covered damage to property insured at the premises, with the word damage defined as accidental loss or destruction of or damage to the property insured. One of the insured's arguments was that it had suffered loss and or damage because it was unable to use its property due to the coronavirus regulations. Well, the court struck the insured's claim out as having no reasonable prospect of success, because when it reviewed 100 years of case law, it was clear that loss in the context of property damage has a physical element rather than, for example, just pure economic loss. And that was particularly so given the other pointers in the wording, including words like destruction and damage. And so on that basis, temporary loss of use of the premises caused by the coronavirus regulations could not be considered to be damage. And the judge commented that, quote, loss of property could not sensibly be interpreted as including mere temporary loss of use of property. So in other words, the case highlights that loss or damage in property policies refers to physical loss or damage to the property itself. And in most cases, that will be obvious. For example, fire, flood, wind, and so on clearly physically alter property itself. But I just wanted to mention a couple of cases where the boundaries of damage have been tested. The first is the Nuclear. This concerned a mobile, self-elevating accommodation and work platform that was built on 3 legs, ending with a spud can, which was a large steel box strengthened with bulkheads and brackets. 4 years after construction, serious cracks in the metal were discovered, and it seemed that the spud cans had not been constructed in accordance with the specification. The insured claimed for the costs of repair of the latent defect. Now, the policy covered damage to the subject matter insured caused by any latent defect in the machinery or hull. So the court then went on to look at what damage meant and found that it required, quote, some change in the physical state during the policy period. But it went on to say, if a latent defect has existed at the commencement of the period, and all that has happened is that the assured has discovered the existence of the latent defect, then there has been no loss under the policy. The assured has to prove some change in the physical state of the vessel. If he cannot do so, he cannot show any loss under the policy. And even though the insured would suffer financial loss arising from its detection of the previously existing latent defect, it wasn't able to recover under this form of policy because it couldn't point to any actual physical change in its property during the policy period. In passing, I would say that this kind of issue is common in machinery breakdown claims. For example, it's not unusual for industrial machinery to be stopped due to the discovery of a crack. And the question is, did the crack occur during the policy period, or was it merely the discovery of a latent defect that had arisen beforehand? But what about invisible damage? Well, that question arose in Coram and Schramm on the slide, which concerned a fire at a fine art storage facility, causing the owner to claim for diminution in value to its Degas painting. There was no relevant visible damage to the painting, but the court found that there probably was submolecular damage to the pastel caused by the fire, and that could be considered, quote, damage, end quote, to the picture. The judge said, in my view, such damage is clearly direct physical damage resulting from the fire, even though it might not be visible, and its extent could not be determined without testing, which could not be carried out because of the effects on the pastel. So even invisible damage can be damage. Next slide, please. But so now I'm going to turn on to deprivation loss. And what I mean by that is loss of property in the sense of the insured being deprived of it within the policy period. Clearly, policies insure against loss where there is, will respond to loss where there has been permanent deprivation of the property. But the tricky question in practice is, how do you know whether the deprivation is of sufficient permanence to constitute a loss? Well, and confusingly, in this regard, the position under marine and non-marine insurance is slightly different. Marine insurance recognizes two types of loss. Firstly, there is actual total loss, which will exist when the insured is irretrievably deprived of property. And that concept is fully spelled out at section 57.1 of the Marine Insurance Act, which is on the slide. You'll see the mention there to this concept of irretrievable deprivation of property. Now, you might think that's pretty straightforward, but it still begs the question of exactly what irretrievable deprivation means. And that issue arose relatively recently in the case of Macefield and Amlin. In that case, pirates had seized a ship and its cargo in the Gulf of Aden and demanded a ransom. The ransom was in fact paid 6 weeks later, and the crew, vessel and cargo were all safely returned. Nevertheless, the insured cargo owners claimed for actual total loss of their biodiesel, saying that they had already been irretrievably deprived of their property when the vessel had been seized. Well, the court disagreed with that and found that there can't be an actual total loss where there is a strong likelihood that the property can be recovered. And that was the case here, where it was clear from an early stage that the ransom for quite a modest sum in relation to the value of the property was being asked for. It was a wait-and-see situation and not one of irretrievable deprivation of property. So the case really shows that as long as there is a reasonable chance of recovery, even by payment of a ransom in that case, then an actual total loss won't have occurred. We have the next slide. But marine insurance also recognises the concept of a constructive total loss. This concept was developed as a special concession to ship owners to prevent them having money locked up in ships whose fate they were unable to ascertain and prove. A constructive total loss is defined in section 62 of subsection 2 of the Marine Insurance Act, but which is set out on the slide. But for present purposes, there will be a constructive total loss if it can be said that the insured has been deprived by a peril insured against of possession, and that it is unlikely that he will recover that property within a reasonable time. And it's been held that unlikely in this section means that recovery is against the balance of probabilities. So constructive total loss will in many cases be easier for an insured to prove than actual total loss, but it still requires the insured to persuade a court that recovery of its property is, quote, unlikely, end quote, and that necessarily involves at least some element of crystal ball gazing by the court. And the law books are littered with cases concerning lost or allegedly lost vessels or cargo falling on either side of the line, but I'm afraid which we don't have time to dive into today. Next slide, please. But how is loss in this sense of deprivation loss approached in non-marine insurance? Well, the concept of constructive total loss does not exist in non-marine insurance, which means that the insureds will need to demonstrate the actual total loss of their property, which, as we have seen, is a harsher test than the constructive total loss approach of simply having to show that recovery is unlikely. So in some cases, it's obvious when an actual total loss has suffered. For example, the 15 Kuwait Airways aircraft captured at Kuwait Air Base by Iraqi forces during the first Gulf War and subsequently flown to Iraq were held to be lost at the point the airport was captured, because they were a specific target of the Iraqi forces, and there never was a realistic chance of recovery at that point. But what is the actual test the courts use in non-marine insurance? Well, it's been said that mere temporary deprivation would not, under ordinary circumstances, constitute a loss. On the other hand, complete deprivation amounting to a certainty that the property could never be recovered is not necessary to constitute a loss. It is between these two extremes that the difficult cases lie. That passage came from the 1917 case of Moore and Evans, in which pearls sent to a bank vault in Belgium before World War I were held not to be lost simply because they were inaccessible whilst the war continued. The evidence was that they were in a bank vault for safekeeping, and there was no reason to think that they would leave the bank vault or not be returned when the war ended. And this is the way the trial judge approached it, or set out the test, and that's set out on the slide. If the true conclusion from the facts existing at the time of the action brought, and he means the legal action, was that the plaintiff's chance of recovering their jewels was a mere chance, then the plaintiffs might be entitled to recover on the ground of a loss of the jewels. On the other hand, if the facts indicated that the chance was all the other way, and that there was no reason to suppose from anything that had happened up to the date of trial that the plaintiffs would not ultimately recover the goods, though they might have had to wait a long time for them. And that probably remains the best test for deprivation loss to this day. If the insured can persuade the court that at the time of trial, it has no more than a mere chance of recovering the goods, then the court may conclude that they have in fact been lost. Simply showing that recovery is uncertain is unlikely to be enough. Now, in passing, I'd note that the court's conclusions on these cases will be influenced often by the insured's behaviour. For example, if the insured can prove that it has carried out exhaustive searches or made other efforts to recover its property, then it will be easier for the court to infer that the goods have in fact been lost. And conversely, if an insured has made no effort to try to find or recover its property, then a court may be harder to convince. Finally, the cases show that in some dynamic situations, it's necessary to wait and see what happens before it becomes clear that a loss can be proven. This wait and see category can be relevant to evolving war or political violence situations, and was applied by the Court of Appeal in Scott and Copenhagen Re. In that case, there were 16. That case concerned also concerned the invasion of Kuwait airport during the First Gulf War. There were 16 aircraft on the runway altogether on the 2nd of August 1990. 15 of the Kuwait Airways aircraft were seized and flown to Iraq, and they were lost at that point, as we have discussed. However, the Scott and Copenhagen Re case concerned the one British Airways 747 that remained on the runway and was not flown away by Iraqi forces, and was later destroyed by Allied bombing on the outbreak of war between Iraq and the UK several months later. The question, for aggregation purposes, was the BA plane lost at the same time as the Kuwait Airways aircraft, i.e. when the Iraqis seized the airport in August 1990. The High Court found that the British Airways aircraft was in no sense a target of the invasion, nor did it become one later in a relevant acquisitive or retributive sense, but it was merely stranded when the invasion occurred. So that had the question been asked on the 2nd of August 1990, i.e. just after the Iraqis took over the airport, the answer would have been, I don't know, wait and see. And in other words, even though the plane had been stranded in Kuwait from August 1990 to February 1991 in enemy territory, it didn't necessarily follow that the British Airways aircraft had been lost due to the occupation and stranding. In fact, however, it was later blown up during the Allied invasion, and so was undoubtedly lost at that point. So this case and Moore and Evans illustrate that the bar for proving loss in non-marine insurance is quite high. Mere abandonment, stranding, or inability to access or use one's property does not necessarily amount to a loss. And going back to the test from Moore and Evans, the best test in non-marine insurance is that the insured needs to be able to persuade a court that there is no more than a mere chance of it recovering its property. So I think I've used up all of my time. I'm happy to take any questions if there are any.
Yes, Andrew, we do have one. And the question is this. If I'm an insured, what do I do if I'm unsure as to whether my insured item is actually missing, because I still believe that it will materialize or that I'll find it, but in the meantime, the policy expires?
Well, thank you. Well, it's possible that you could be in an invidious situation, because but you might get some assistance, and there's a slight difference between the marine and the non-marine cases. So you might be in an invidious situation because although you can't find it in year one, you can't be sure, and then your policy expires. But perhaps your inability to find it would be a circumstance you need to disclose to your year two insurers, who may refuse to insure you or impose difficult terms. So that could work some injustice. In the world of marine insurance, there is a concept of the grip of the peril or the death's blow, which essentially is where a damage to a property starts in year one, but the loss materializes or becomes clearer after the expiry of the policy due to a sequence of events in the ordinary course of events. Then the loss can relate back to when the original loss or damage started in year one. But it's not actually settled if that principle applies to non-marine insurance, and difficult situations can arise for insureds in the position you described.
So presumably the answer must always be that an insured needs to understand the parameters of the terms of its insurance and the period of that cover.
Well, that's right. I mean, the best advice would be, of course, to tell the insurer anyway, the first insurer, and also to carry out in any case, a diligent search for the property.
Thank you very much. We are out of time now, so I'll pass back to you to conclude, if I may.
Thank you very much for your attention. Goodbye.